LJ, good to have you in studio. Last year, volatility in the commodity markets was driven, amongst other things, by geopolitical tensions, US trade tariffs, and China's slowdown. What three key themes do you believe will drive volatility in the commodity markets in 2026?
Yeah, thanks, Quenza. So we think this year geopolitics will remain a big factor in commodity market volatility. But what we like to call it at RMB is we call it geoeconomics. So this takes into consideration the geopolitics as well as the macroeconomic factors. The geopolitics are well known by everyone in the market and how that's affecting commodity prices. But I think on one side, something that we really want to emphasize is that on a macroeconomic perspective as well, we are seeing, increasingly investors moving away from the dollar. And when investors move away from the dollar pricing has been quite weak. The dollar is at 4-year lows, and that has led to two effects. Number one, commodities are priced in dollars, and we've seen an uptick in commodity prices. Secondly, what has happened as well is now we've seen investors move to real assets because they're worried about the future prospects of the dollar, and they're moving into real assets like commodities. I think a third thing as well to think of as well is when you look at the developed markets and their debt to GDP ratios, they're quite high, and they're quite high, and actually growth is a little bit subdued. So what's happening now is investors are questioning the long-term viability of the fiscus, and that's why they're also shifting towards commodity markets. As a last point, something that we cannot ignore is actually the confluence between artificial intelligence and renewable energy, or the transition. If you look at those two mega trends, all of them are commodity heavy. So going forward, we will still see this increased demand for commodities.
As we expect the intersection of AI and renewable energy, or the transition thereof, will drive quite a high demand in commodity markets, what risk management tools should investors consider to navigate the heightened volatility in commodity markets without being overly defensive?
So our view is, we believe that, the commodity markets have rallied quite aggressively this year. So you've seen everything from PGMs, precious metals, dated Brent is also rallying at the moment. So in a market like this, what you want to do, for example, as a producer, what you want to do is you want to basically manage two things. Number one, you want to manage downside price movement, so price protection, but you also don't want to cap your upside. And the best product that allows you to achieve those two objectives is to be looking at put options. So we're seeing quite a lot of activity in put options from our clients because of those two main reasons. What we say as well is that what we've seen some of our clients do, given that where prices are now, they're quite a distance away from all-in sustaining costs. What clients are starting to do now is they're starting to actually leave orders a few $100s away from the current price of the actual commodity that they're producing, just so that if there is a sharp pullback, they are protected. Because as quickly as commodities can go up, prices can pull back very sharply as well. So I think as a commodity producer, you really want to stay protected in this kind of environment, but you don't want to cap your upside as much. So that's why put's a very good option at the moment.
Let's unpack RMB's differentiated approach by really walking through how we executed and structured our largest gold hedge ever, which enabled Asante Gold Corporation's $500 million financing package.
Yeah, Quenza, I'm actually very proud to speak about that transaction. I mean, it was a $1.9 billion transaction that we did as a bank. And in terms of how we put it together, I mean, obviously we had a very long relationship with Asante, and this deal was in the works for quite a long time. I think number one, what differentiated us is the fact that we have a very strong transactor team. We have a very strong internal credit. So they understood the asset, they understood the client. So from that, it made our job as a markets team in terms of actually structuring the transaction, it made it actually very easy to actually do that. The second thing is how we covered Asante. We had the IBD transactors who were speaking to the client on a regular basis. as well as we had markets transactors who were speaking to the client on a regular basis. And what that allowed us to do is it allowed us to work as a team and really come up with the best structure possible for the client. And when we came up with the structure is we balanced two things. Early on in Asante's journey, they needed price certainty. So how we structured the hedge, it was structured to actually guarantee that. And then in the later years, they needed flexibility. And that's why we structured the later years with puts as well, which is what I was saying earlier. This allows the client to have actual flexibility to participate in these increased commodity prices. I think as a third thing, also, what was very impressive internally as a bank was that every single person in the bank was able to come together and was able to actually solution for the client in the most efficient manner, all the way from our onboarding team, our credits, our transactors, our trading desk. Every single person brought their A game for us to solve the client's problem, provide them with a solution that works. And I think all parties were happy with the outcome.